According to a new shocking report from RBC, Canadians are financially paralyzed. So what on earth does this mean? And is the bank doing anything about it? So let's get into it. As one of the primary lenders, you would think maybe, but probably not. So financially paralyzed, half of Canadians living bill to bill. So more than half of Canadians are feeling financially paralyzed amid the surging cost of living, according to a new poll. But you know what, guys? I thought inflation was coming down. It's just so stupid, isn't it? We know it on this channel. So 55% of Canadians use that language to describe their finances, according to the survey commissioned by the Royal Bank of Canada. Nearly half, 48%, added that they could no longer afford to maintain their standard of living, while nearly a third, 29%, said their finances were in a constant state of chaos. And you know, you've just got to think of that. That is literally depression sort of language. And you've also got what they're saying there is their standard of living is declining. So it's something that we've been saying for years on this channel, but it's even coming out in the mainstream media now. And the Royal Bank of Canada is even commissioning reports to be done on this. And you would think they would be doing it to look at risk and think, hey, we need to diversify a lot more because we got a lot of this consumer debt on our balance sheet. But I don't think they will because of the way the banking system works. So it's having to make decisions. Which bill am I going to pay next? Am I going to ask my family for money perhaps, or move in with relatives, said Craig Bannon, Director of Regional Financial Planning Support at RBC. So this really isn't looking good when you look into it. And then it also said more than a quarter, 27%, said they'd taken on more debt to cover monthly basic needs, while almost 1 in 5, 18%, said they are already over the edge financially. And again, this is so crucial. When you look at these sort of surveys and reports, you're getting an insight into the consumer and what is going on, because a lot of people see these reports and they go, well, I'm doing fine, so I don't really care. But you got to look at it from the mindset of, okay, you might be doing all right, but now you're looking at the people who aren't doing all right, and are they going to stop paying your bills? You know, if you're a landlord, that could be your renter. So everything could directly affect you. So just because everything's going fine right now, it doesn't mean you should just sit there and say that. You got to prepare. You got to prepare for the worst, hope for the best. That's the best way to do it. So it's very interesting what's going on. And now I want to show you this as well, because the M2 money supply has been growing. But what you have to think about is since 2022, when we've been in this recession, you've seen obviously the money supply that has just gone up and up and up, and it has gone down at different times, and it's slightly paused, but it's mainly just continued up here. And this is a result of lending. This is a result of banks creating more credit. Now, if I go back to this report and you see more than a quarter, 27%, said they'd taken on more debt to cover basic needs, and 18% of them are already over the edge financially, how does that make you feel about a lot of that debt that has been specifically created over the past 2 years, part of the money supply, and how risky that debt really is? And it's all at really high interest rates, because interest rates, sure, they've come down, but for the majority of the time, it's been at really high interest rates when you look historically and considering the debt levels, because the debt levels are insane compared to what they were back in 2005 when interest rates were the same, for instance. So it's very interesting. And then also, you've got this happening, more and more losses in the housing bubble. You know, this is just another insane loss. So this sold for $1.56 million in 2022 February. It's always 2022 February. And they tried to sell it a bunch of times here, and they finally ended up selling it for $1,050,000, a $510,000 loss. So that's a 30% loss, and it's just absolutely insane. And when you look at, even as Shazzy points out here, even counting commissions, fees, taxes, and holding that property, when you look at the amount of money they've lost, and then you factor in inflation as well, they've just been absolutely demolished. And you're still selling the house for $1 million, which nobody can afford. So one has to ask the question, when you look at the Oshawa median income, which I'm guessing is going to be like something like $70,000, $80,000. How on earth can anybody afford $1 million? It's just there's so much fraud going on in the housing market, and it's of course just brushed under the rug. And then you've got Toronto owners struggle to sell their homes. There's nearly 20,000 homes sit on the market in the Toronto housing bubble right now. So again, this is just really insane numbers here, and it's really the numbers that you have to look at. So according to the Toronto Real Estate Board, which released the latest market figures this week, there were 7.9% fewer homes changing hands over the course of last month than in January 2024. So January 2024 was an abysmal year, and January 2025 has been even worse. And when they say homes changing hands, they're talking about sales. So sales just continue to plummet as we're waiting for this housing market to just boom. And even though the weather has been extremely cold and there has been a lot of snow, it doesn't put off home buyers when they really want to buy homes. I mean, look at the pandemic as an example of that. But when you get into the amount of homes and the increase year over year in the inventory, that's when rubber really meets the road. There's a 70.2% increase in the inventory, bringing the inventory to 17,157. And when you think about what we just talked about with Calgary and how Calgary's in that mania, finishing up in that cycle right now and could be turning the corner this year, it looks very likely, then guess what? Are they going to end up in the exact same circumstances and situation as Toronto right now? In a couple of years, are we going to be talking about Calgary, Edmonton, Montreal, Halifax in the same way as we're talking about Toronto right now? I mean, you've only got to look at the price appreciation and how ridiculous it's been, coupled with the narratives that have surrounded it, which have bared nothing on fundamentals. That's the main thing. And then Shazzy rightly points out this, that Bell is gutting more jobs, and they've done over 6,000 layoffs in 2 years. But get this, the February 2024 job cut was the biggest in 30 years. I didn't actually know that for Bell. So it's really showing you what's going on, which is a huge shake-up here. And then this comes from National Post. 4 in 5 newcomers to Canada relying on food banks, Toronto report finds. That is like 90%. That is 90% of the newcomers coming to Canada are going straight into a depression. And this is so bad for so many different reasons, because the probability of resorting to crime or drugs or all these different things is just exponentially increasing for these people. Obviously, if they're going onto the street, if they're relying on all these support. So it's absolutely insane. It seems like a global plan to destabilize countries like Canada, the UK, the United States. So as it has annually since the pandemic, the number of people visiting Toronto food banks for the first time soared again over last year, and newcomers to Canada are among the largest cohort of new users. And again, that really just shows you that the jobs aren't there and the economy is absolutely just getting demolished right now. And that's what the Bank of Canada doesn't want to tell you about their interest rate hikes and what happens with them, is that they essentially demolish the economy and it can't just be rebuilt. They just think the economy is a dial that they can turn up and down, which is interest rates, which is just totally stupid and has been debunked so many times. But they learn broken economics. We can't help them there. So this is an astonishing 222% increase in new food bank clients compared to just 2 years ago, the report reads, noting that the figures are an underestimate as they don't include the data from anonymous visits. Overall, the facilities had a record-breaking 3.48 million visitors over the year, 1 million more than the previous and almost 4 times as many as recorded before the pandemic. So again, what is this telling you? And another thing, obviously the Canadian dollar has really been doing bad since last year, particularly around June. It really turned a corner and just started going down, and that just accelerated in September. But I've actually noticed that the foreign exchange reserves are actually going down right now. So that means that the Bank of Canada is actually selling US dollars possibly on the back end to try and prop up the currency. And obviously this never works because central banks have done it time and time again. I mean, I think it was the Japanese central bank that was trying to do this. The Chinese central bank has tried to intervene all the time with exchange rate controls, and it just does not work. So again, you got no gold reserves in Canada, and also the foreign exchange reserves are going down. Now they're going down from a high. If we go to a 5-year chart, you can see the foreign exchange reserves, they really did increase over the pandemic. So they are starting to go down now. But I don't think it's a coincidence. It started in September 2024 when the Canadian dollar really started tanking. So incredibly interesting on that as well. So really bad right now. Canada is in a depression, as we know. So anyway, if you've enjoyed this video, I'd highly recommend that you check out this video over here. And if you're looking for a VPN and want to help support the channel, then please go to expressvpn.com/marketmania. I will see you in the next